Alright, welcome back. So I'm sure if you're into investing and watch other finance or investing channels on YouTube, you'll have heard the axiom that the stock market delivers on average over the long term a 10% return per year. And if we're talking about the S&P 500 and the returns from its inception in 1926 to present, that is in fact true. And I'll get on to more of that in a second, but the point of today's video is to illustrate that even if you were the world's worst market timer, i.e. if you invested near the peak of every stock market cycle, right before the corresponding subsequent bear market, you would still end up with considerable capital gains over the long run, and therefore you should never under any condition panic sell your stocks. So with that in mind, today we're going to be looking at Bob, who is the hypothetical worst market timing investor, as an example to illustrate this point. But before we meet Bob properly, let's just define exactly what the S&P 500 is, and outline some other key facts which will be important for our understanding of Bob's returns. So the S&P 500, what is it? It is a stock market index that measures the stock performance of the 500 largest companies listed on stock exchanges in the United States. The S&P 500 index began in 1926 and was originally known as the Composite Index, composed of 90 stocks, and adopted its current format containing 500 stocks in 1957. Although they should probably call it the S&P 505 at present. Annualized returns for the index from the 1st of January 1957 through to the 31st of December 2019 were about 10.27%, and similarly were about 10.22% from the index's inception in 1926 through to the end of 2019. So now that we have a clearer understanding of the index that we're going to be using, let me also outline that we're going to be looking at the S&P 500 from 1970 to 2013 to capture a majority of the bear markets in and around this period. And for example's sake, we're going to assume that since the S&P 500's inception, that it has always been possible to invest in an S&P 500 index ETF, despite them not actually coming to fruition until 1993. The 43-year time period from 1970 to 2013 is also relevant, because that is probably about how long an average person would expect their working life to be, assuming they began working after graduating university at 22 and worked until they turned 65. Okay, so now you're ready to meet Bob. Bob began his career in 1970 at the age of 22, and to his credit, he was a diligent saver and planner. Bob's problem as an investor, though, was that he only had the courage to put his money to work in the market after a huge market run-up. However, his saving grace was that he never panic sold his stocks. His plan was to save and invest $2,000 a year during the 1970s and increase that amount by $2,000 each decade until he could retire at the age of 65 by the end of 2013. So he saved $2,000 in the 1970s, $4,000 a year in the 1980s, $6,000 a year in the 1990s, and then $8,000 a year from the 2000s until he retired. By the end of 1972, Bob had saved $6,000 and was ready to begin his investing journey, and so invested all of his money into an S&P 500 index ETF on the 1st of January 1973. This timing wasn't fantastic, however, as almost immediately after having done so, the market dropped 48% on the 11th of January 1973. Bob then wasn't sure about investing, and so after the bear market of 1973-74, didn't feel comfortable about investing again until the 1st of January 1987, after another huge bull market. After 14 years of saving, he had $42,000 to put to work. Again, he put it in an S&P 500 index ETF, and again he invested near a market peak just before a crash. This time the market lost almost 35% a few months after Bob bought his index shares. After the 1987 crash, Bob couldn't convince himself to invest another penny of his savings into the stock market until the 1st of January 2000, after the tech bubble had really ramped up. After 13 years, he had another $72,000 of savings to put to work. This time his purchase at the beginning of January 2000 was just before a 50% downturn in March of that year that lasted until 2002. This decision had left Bob hurt, but he decided to make one more big investment with his savings before he retired, and did so in 2007 after seeing the market do well after the tech bubble crash. The final investment he made was on the 1st of January 2007, after another 7 years of saving, and he invested $56,000. His final investment rounded off his string of horrific market timing calls, as he bought a few months before the 59% crash from the subprime mortgage crisis. After the financial crisis, Bob decided to keep his subsequent 7 years' worth of paychecks of $56,000 in the bank to save for his retirement, where they sat earning 0% interest. Now luckily, while Bob couldn't time his market buys, he never sold out of the market even once. He didn't sell after the bear market of 1973-74, or Black Monday in 1987, or the dot-com bust in 2000, or the great financial crisis of 2007-09. So how did Bob end up doing? Well, even though he bought near the highs of the market throughout his investing career, Bob still ended up a millionaire, turning his total invested amount of $176,000 into $1.13 million, and adding that with his uninvested 7 years' worth of paychecks, he would have retired by the end of 2013 with a total amount of $1,186,920. So what can we learn from Bob? We can clearly see that even if you were absolutely horrible at timing the market, you still would have done reasonably well by simply staying invested in the market and not panic selling your stocks. Some of you may be wondering by about now though, how Bob would have done if he had simply dollar cost averaged into the market throughout his career. Well, to answer your question, he would have done almost twice as well, and ended up with a total of $2,143,379. This figure does of course involve a few assumptions, however, but I did try and reduce the variables between Bob's strategy and a dollar cost averaging strategy as much as possible. So for instance, I assumed that again, under a dollar cost averaging strategy, that Bob would invest $2,000 a year during the 1970s and increase the amount invested each decade by $2,000 until he reached $8,000 by the 2000, which is the maximum amount that he would invest per year until he retired. I also assumed in my calculations of a dollar cost averaging strategy that Bob would invest each year until he retired at the end of 2013, instead of stopping after 2007, and that he would receive an annualized return of 10.22% on his investments, because, as mentioned at the beginning of the video, that is in fact the annualized return of the S&P 500 since its inception, and so seemed to me the most logical single interest rate to use. But just going back to Bob quickly and what lessons we can take away from him, I think it's key to learn from Bob based on his horrible market timing versus implementing a dollar cost averaging strategy, that dollar cost averaging reduces the risk of you investing a lump sum potentially right before a market crash, and therefore, simply put at least, dollar cost averaging increases your long-term returns. I also want to add that if bear markets in the past have taught us anything, it is that they are often very difficult to predict, and so it is probably wise to dollar cost average yourself into the market when buying index ETFs. Okay, so just before I end the video, I want to leave you with one last thought, and that is that if Bob had retired 1 year earlier and sold all of his stocks by the 31st of December 2012 to live off, he would have been significantly worse off, retiring with an amount of $930,180. This is because 2013 was a lucrative year for the S&P 500, and so it's worth bearing in mind that sometimes it is simply the luck of the draw in terms of how well your stocks perform over your specific investing lifetime. And with that being said, I hope you found the video informative, and if you enjoyed it, please like and subscribe for similar videos going forward, and I will see you in the next one.